3 ASX growth stocks you shouldn't ignore. What is up everyone, it's David here. Now a few of you have slid into my DMs and also in the comment section asking me to do a growth stock video. And you ask and I shall deliver. So here are the 3 ASX growth stocks that you shouldn't ignore in my humble opinion. And before we start,
no, relax. I'm not gonna ask you to gently smash that like button right there.
what I was going to ask is, if you think that I evaluated these stocks unfairly, or you think there are more ASX growth stocks that's out there that I completely missed, let me know in the comment section below. That way, both the YouTube community and also I get to learn something new. And without further ado, let's go. Just a quick note so that we're all on the same page. A growth stock to me is just a company that's growing significantly faster than the market returns. Over a span of 20 to 30 years, the market on average returns approximately 9 to 10%. So a stock that's growing faster than that, in my opinion, is a growth stock. Now, there are 3 main things that I look for when it comes to a high quality growth stock to hold. 1, earnings needs to be growing year on year. 2, they need to have a strong balance sheet to withstand an external shock or something that's going to happen in the market by chance. And 3, even though it is a growth company, I would like to see beginning glimpses of an economic moat, or they've already established their first moat. So with that out of the way, the first one is A2 Milk. Now, A2 Milk is an ASX 200 company that sells A1 protein-free liquid milk and also infant formula products. Now, majority of their revenue is done through Australia, China, and also US. Let's dig into its earnings and see what's under the hood. Over the last 5 years, A2's earnings have been growing by a whopping 57.7%. Now, the store count that's carrying their product in China grew from 3.8 thousand stores in June 2017 to 18,000 stores at the end of 2019. And their trajectory of growth is largely caused by a stronger demand both domestically and especially in China. Now, there's a couple of things I want to make note of before we move on to the balance sheet section and talk about that. Now, one of the first thing is, before 2019, daigous, which essentially means buying on behalf of someone else, would literally max out the 2 per customer limit in Woolies store and buy out all of the A2 product range on the shelf. That's because Chinese customers will pay upwards of 50% premium on top of the shelf price in Australia. And because a lot of these daigous would take the product that they bought in Australia and fly it back to China, and when they cross border, they'll claim it as personal use. There's not a lot of taxes going on. So this is one of the gray areas of cross-border e-commerce. After January 2019, the Chinese government have imposed a mandatory tax on these daigou merchants. And on top of the travel ban more recently, a lot of those factors isn't very likely going to impact the consumption of A2 products in China. It just means that the demand for A2 products will be rerouted to official cross-border e-commerce companies like Tmall, that's part of Alibaba, and also JD.com, which is one of the largest e-commerce sites in China. So that's enough fanboying, so let's move on to their balance sheet. So from a single glance, their short-term assets well cover their short-term liabilities and their long-term liabilities. And in their most recent half-yearly report, $618 million of that short-term assets are cash. So they definitely have the strength in balance sheet to withstand any external shock, or they could spend that money to scale faster in China and US. A2 doesn't have any debt as of 31st of December 2019, which means that for whatever reason they need debt in the short term, the banks will probably happily lend them, and considering where the interest rate is at the moment, that's probably a really cheap way of financing if they do need the money. Okay, so let's talk about something that I'm quite excited about, and that's their economic moat. Their biggest moat by far is their brand perception. When it comes to Chinese consumption, the middle class are very loyal to brands. And it doesn't matter if the prices go up, the demand will stay the same. That's why there's a couple comments coming from asset managers saying A2 products in China have inelastic demand. And this is especially true if the brand has a premium perception attached to it. Because in China, consuming premium products reinforces their social identity in that society. Now, in my culture, there is a lot of social hierarchy at play at all times. Have you ever wondered why when you pour someone else's tea in yum cha that you find other people tapping on the table? That's a signal of a bow back in the days. And that originated from the Qing dynasty when the emperors would go visit other parts of the country and he doesn't want to reveal his identity. So that was a way for the servant to say thank you without revealing his identity. Now the prospect of the industry is bright, especially with A2 Milk starting to cater to early stages of maternity like A2 nutrition for pregnant mothers. Now, if they're able to succeed in doing that, it's very likely they're going to dominate a big chunk of the customer lifecycle for having a child. And that essentially means there's a higher lifetime value for any of their customers, and that should lead to a higher profitability down the track. Oh, by the way, I own A2 Milk in WAM Research, and I dollar average into the fund. So now feel free to let me know in the comments below whether you think the stock is too cheap or too expensive to get in right now. From my last video, some of you were really kind to drop me some very detailed comments around whether you think some of the stocks are too cheap or expensive, and I love reading that. So if you want to leave a comment, feel free to do so.
But David, what about Bubs? They just signed a distribution deal with Coles and Woolies and a bigger deal with Vietnam's biggest baby chain store.
If that's something you want me to cover and more small cap growth stocks, make sure you gently smash that like button, and if this video gets 500 likes, then I know there is enough demand to create a full video on that. It just takes a long time to do research on those. Now the second ASX growth stock I have for you is Fisher and Paykel Healthcare. I don't know how to pronounce the second word. They are a leading designer, manufacturer, and marketer for products used in respiratory care, acute care surgeries, and also sleep apnea. So think of oxygen mask in respiratory care, or ventilation or intubation tubes if you need help with breathing in intensive care units. So when it comes to earnings, over the last 5 years, FPH have grew their earnings by 15% and their net profit margin improved by 3%, which is a great sign of operational excellence. Now, the earnings growth is mainly driven by their hospital product group. And in their most recent half-yearly report, that product group's earnings have grew by 19%. On top of that, they just finished rolling out a SAP enterprise resource planning software across all of their North American operations. So we should see further efficiency improvements over the next year and onwards. Also, this sounds really bad, but the pandemic has really pushed this company's earnings forward because as part of the recovery process, a lot of people who were sick required oxygen support, and some of the more critical cases, they needed intubation and ventilation. I'm obviously not a doctor. I just read this from WHO's clinical management report. Now, when it comes to their balance sheet, their short-term assets well cover their short-term liabilities and their long-term liabilities. And with $48 million in cash, there's definitely strength in balance sheet, and they shouldn't have any issues when it comes to weathering the storm in the short to medium term. So from a debt to equity standpoint, for every 10 cents of debt, there is $1 worth of equity. So that's really safe. And I'm sorry, the data points I have is a little late because those statistics is on the 30th of September 2019. But in their most recent half-yearly report, they have approximately $145 million worth of debt facilities from a bank to draw from if they really need it. So let's talk moat. When it comes to moat, FPH have two main economic moats: a strong brand and also a high switching cost. Now, because their products and systems are mostly sold to hospitals, the switching cost from one brand of product to another brand of product is really high because you're dealing with respiratory care units and intensive care units here. Any errors that you make will be a fatal mistake, literally. When it comes to the future prospects, looking ahead, the demand will continue to grow steadily in hospitals as they stock up respiratory consumables. And even after we find a vaccine for this pandemic, there's still other use cases to drive demand from FPH. So we'll see how things pan out over the next couple of years. So because FPH wasn't really affected by the pandemic, the share price is at its all-time highs. From that perspective, it's probably a no-go for bargain hunters. And just for your transparency as well, I own this stock because T. Rowe Price owns it. And because T. Rowe Price is a diversified investment management company,
My position is probably so small that you'd laugh at me.
the third ASX growth company I have for you is IDP Education. This is an international company helping students get placements in Australia, US, New Zealand, Canada, and a few of the other European countries. So think about IELTS testing centers, immigration visas, or helping students apply for universities or TAFE here in Australia. So when it comes to earnings, over the last 5 years, they grew their earnings by 19.7%, and their net profit has improved from 11.3% to 12.4%. Now, there are three main things that contributed significantly to their earnings growth. The first one is there's a stronger demand of student placements coming from India, Canada, and UK. The second is marketing automation. And the third thing is that organic traffic improvements to IELTS, IDP in multiple countries. So I'll put the traffic improvements on the screen for you right now. Okay, so just to give you a quick demonstration of how much the search traffic have improved by, this is IELTS.org, which is one of the website IDP owns. This is the United States database. And as you can see, the traffic have been growing quite consistently. And even though there was a dive, and I think there could be an algorithm change or some kind of issues with the website, but generally speaking, it has been trending upwards, which is really nice. Similar cases when it comes to Canada, India as well. India is a little bit flatter,
but definitely a lot more traffic, as you can see. Now, traffic is an estimation only, and essentially what this means is that there is approximately 531,000 visits every single month to this website. It's just an estimation, so take it with a grain of salt. At the same time, with idp.com, as you can see in Australia, it's been growing very, very consistently, very steadily, which is great.
So between social media marketing or SEO tend to yield a higher return over the long term. On the other hand, when it comes to search traffic, you're at the mercy of Google. So if they decide to change your algorithm, you might suddenly lose a big chunk of your traffic. As long as you play by their rules, you should be okay. So in this case, it seems like IDP and IELTS is doing a great job. Now, when it comes to the balance sheet, the short-term assets well cover the short-term liabilities almost by 2 times. So they definitely shouldn't have any issues weathering the storm for the rest of the year. Now, when it comes to debt to equity ratio, for every 34 cents of debt, there is $1 of equity, which is quite safe in my opinion. But there are 2 things to note here when it comes to the debt to equity ratio. They recently raised $225 million in the equity market in April, and they also secured a $150 million debt facility from a bank if they need to spend it. They definitely didn't leave any stones unturned, and they did all the necessary things to prepare whether the future road is bumpy or smooth. Now let's talk about economic moat. They have a 50-year history in this business that has given them a very reputable brand with both the students in their respective countries and also our universities. Now, this brand perception has translated in authority in search. People won't search about something if they don't know what that thing is. So from some of the previous screenshots that you saw, the increase in search traffic is an indication that people are getting to know a brand better, which in my opinion is just as much as an economic moat as your brand perception. So I think there are 2 independent moats that complement each other. Now, given the digital transformation initiatives they underwent, like marketing automation, and the risk they took on by investing in technical infrastructure to support testing done online, I'm starting to see glimpses of 2 additional moats. And the first one is cost advantage with their scale. And the second one is a network effect advantage. So let me further explain what I mean by a network effect advantage with IDP education. Think about what happens when a student gets placed. They celebrate with their friends and family. And when they do, their friends and family, and especially their children, is going to ask them how they did it. And I can promise you, somewhere along that conversation, IDP's name is going to pop up multiple times. And as more people get placed, the more of a reputable brand they are. So their services will get better. Okay, so let's talk about future prospects. And this is a pretty interesting one in my humble opinion. Because of the pandemic, it affected IDP education's ability to deliver IELTS testing in physical locations. And some of the students can't take classes either because of the travel ban and they're stuck overseas, or can't go to universities because they're mostly doing digital learning at home. But here's why I'm not overly deterred from this. IDP education earns income from 47 countries. That immediately diversifies their income stream. So if they lose one for whatever reason, that should be enough to give them a bit of breathing room to take some appropriate actions. On top of that, they recently launched a digital campus in Chennai, India, and that will support a big chunk of the digital education demand coming from India. Not to mention, it will allow them to test mobile applications like the Study Abroad app they just released, and lowering operating costs by outsourcing some of the repetitive and labor-intensive efforts to their digital campus. Now, because of the reasons I just mentioned, I'm not overly concerned about the pandemic's impact on IDP moving forward. And because of the pandemic and also capital raising, it seems like they're in bargain territory. Or are they? Let me know in the comment section below in terms of what you think. And that's it for this video. It was definitely a little bit more on the challenging side to research these stocks because I'm traditionally a dividend growth investor. So if you enjoyed this video, make sure you gently smash the like button if you haven't already. Subscribe to my channel, click on the bell so that in a few days when I release a update on my portfolio, you'll be the first one to know. And Otto will do the honors. And see you very, very soon.